In this video, I would like to discuss risk management strategies for successful stock investing. Effective risk management is crucial in stock investing to protect your capital and maximize potential returns. Here are key strategies and concepts for managing risk in stock investing. Number one is diversification. In other words, you spread your investment across different sectors and different industries, as the case may be. So you invest in a variety of stocks across different sectors, industries, and geographic regions to reduce the impact of any single investment that may perform poorly on the overall portfolio. Number two is asset allocation. Asset allocation. So this particular concept has to do with maintaining a balanced portfolio. You balance your portfolio. So allocate investments, among different asset classes. Example is stocks. You have bonds, as well as cash. Cash is the most liquid form of investment. So this is based on your risk tolerance, investment goals, and time horizon to balance risk and reward. So you have a decent level of asset allocation. Not only that, you have number three, risk tolerance assessment. Risk and tolerance assessment. In other words, you understand your limits. And so evaluate your risk tolerance based on your financial situation, investment goals, and a psychological comfort with market volatility to guide your investment decisions. So first of all, you have to identify your risk tolerance level. Is it moderate? Is it conservative? Is it aggressive? So based on your risk tolerance, you now tailor your investment based on the level of risks you are able to accommodate as an individual. Number four is position sizing. Position sizings. So when it comes to this particular aspect, you manage your individual exposure. So limit the size of each individual investment relative to your total portfolio to prevent significant losses from any single stock. In other words, you have your different stock investment. You now position, you now size your positions based on your risk tolerance. For instance, you may have, let's say, 10 stocks in your portfolio. You may decide to give each stock 10%, 10%, 10% of your capital outlay. By so doing, you have a decent position sizing. Number five is stop loss orders. Stop loss orders. In other words, you automate your exit strategies, or you automate your exit points. So you use stop loss orders to automatically sell a stock if its price falls below a predetermined level, helping to limit potential losses. If your stop loss is at, let's say, $2 and the stock is selling at $5, whenever the price falls, to close to $2, when it gets to $2, the stock will be automatically, sold out, so as to avoid, further fall or further losses in the stock price or in your investment. Number six is take profit orders. Take profit orders. In other words, you lock in your gains. So take profit orders to sell a stock when it reaches a certain price, securing profits and avoiding the risk of losing gains during market correction. If your profit order is at, let's say, $6, when the stock rises to the $6 level, the system will automatically sell your stocks so as to lock in your gains. Number seven is regular rebalancing. Regular rebalancing. In this case, you adjust your holdings. So periodically review and adjust your portfolio to maintain your desired asset allocation and risk level, especially after significant market movements. Number eight is use of hedging. Use of hedging. So you hedge in order to mitigate risk. So employ hedging strategies such as options or inverse ETFs to protect your portfolio against portfolio, losses, that arises as a result of market decline. So you could use reverse, or inverse ETF. It has to do with the benchmark you are dealing with. In the case of reverse ETFs, when the benchmark goes down, the portfolio, your ETF value will go up. And in a case where the benchmark goes up, unfortunately, your ETF value will plummet. Number nine is research and analysis. Research and analysis. So stay informed. Conduct thorough research and analysis of the stock you invest in, including understanding their fundamentals. You understand the market condition as well as the potential risk associated with your portfolio. So you have to conduct thorough analysis and research so as to stay informed in the markets. Number 10 is economic and market indicators. Economics and market indicators. So in this aspect, you monitor your trends. You monitor trends in the market. So keep an eye on economic and market indicators that could affect stock performance, such as interest rates, inflation, as well as geographical events. All these factors could, one way or the other, affect the performance of your stocks. Number 11 is avoid emotional investing. Avoid emotional investing. So stick to a strategy. Avoid making investment decisions based on emotions like greed, like fear. Stick to your investment plan and make decisions based on analysis and strategy. Number 12 is use of stop limit orders. Stop limit orders. That's control selling price. In this aspect, use stop limit orders to set a stop price and a limit price, ensuring that you sell a stock within a specified price range if it falls below your stop price. So in this particular case, once it gets to the target price, the system will automatically sell your stocks so as to curtail losses in your portfolio. Number 13 is contingency planning. Contingency planning. So prepare for market downturns. The market will always fluctuate, so get prepared for that. So have a plan for different market scenarios, including potential economic downturns or market corrections, to minimize the impacts on your investment. Number 14 is diversify investment vehicles. Diversify investment vehicles. In this case, you diversify across different asset classes. So consider diversifying beyond stocks into other investment vehicles like bonds. You consider real estate. You take into consideration commodities to reduce, your overall portfolio risk. Then lastly, number 15 rather, you continue learning. Continue learning. Stay educated. Stay informed, because the more informed you are, then the better your yield will be. Of course, the more you learn, the more you are going to earn in the market. The market actually is driven by information, by knowledge, by skills, and of course by experience. And so all these factors, what you would take into consideration so as to limit or mitigate your overall risk when it comes to investing in stocks.